This is Victor McClure, the president of the McClure Capital Companies. For almost 40 years, I've been given advice on how to manage your finances. One thing that comes up a lot is high yield bonds. High yield bonds, the definition of a high yield bond is anything below triple B. Okay? The reason they're so popular is people are looking for yield. And so they'll buy high yield bonds to get more yield. The problem is with high yield bonds are the default rates are much higher. They're going between 12 to 50% default rate. Why is that? Okay. Well, these are companies that have to pay more, right? In other words, think about it when you're buying a mortgage. If you're getting a mortgage and the going rate's 5%, why are they quoting you 7%? It's because you have bad credit. You don't have enough assets to back them. Your claims, your paying ability, your credit history is not good. You don't pay things on time or don't pay things at all. That's the same for companies, right? Why would you own your cousin that has bad credit and doesn't pay his people back and doesn't have a good job? Why would you loan them money? Same thing. Why would you loan a company that doesn't have the right financials or anything else money? There's a reason why they pay more. They pay more because they can't get it from a bank for lower, or they can't get it in their AAA bonds. Okay, and so that's why they used to call these junk bonds. What happened is Michael Milken with the junk bond king and all that stuff, they don't call them junk because you can't sell something called junk, right? You could sell something called high yield. High yield sounds good. It's the exact same thing. There is zero difference between a junk bond and a high yield bond, okay? The problem is a lot of people, a lot of these income planning people will put you in a whole bunch of them. They're like, no, we have 20 different funds with 1,000 different issuers in there, so that makes sure that you're not going to lose money in it. Truth is, you got a bunch of junk. You just got a whole bunch of junk. Yes, you've eliminated some of the individual issuer risk because you have so many, but the overall market has been good. Think about it. The market's gone up almost, if you take out 6 months in 22, it's like 15, 16 up years in a row. Everything's been good with the economy, so junk bonds have paid. But you don't want your money in junk, all right? Don't invest in this. A lot of things I see, especially on the municipal bond market, okay? They'll buy a DFW airport bond, and they're buying one for 5% tax-free. That sounds pretty good. 5% tax-free when the going rate on tax-free bonds is around 3.5. Why would somebody be paying 5? DFW Airport is one of the busiest, biggest airports in the world. Why? Because there's something called essential and non-essential, okay? When you're building an airport, the essential, you need a runway, otherwise you can't have an airport. But the non-essential would be the snack bar inside the terminal. That's not essential to an airport. But those right there will pay more. They're a revenue bond that's based on that particular thing. What's the significance of that? Well, the significance of that is they make you subject to the AMT, which is the alternative minimum tax. So you bought these tax-free bonds, and now you're going to pay tax on it anyway. So be careful. Anything that's high yield, make that suspect. Don't say, hey, all these bonds are paying 5, this one's paying 7. Now it should be suspect because there's something wrong with it. They have bad credit. It's a revenue bond that's not going to be, it's got a high probability of going bad. So stay away from junk bonds or high yield bonds.